going on, everybody? Good morning and welcome back to Beat the Bell presented by King Capital. Hope you guys are all having an awesome trading week thus far. We've got a very special guest with us on this morning's episode. Hopefully you guys saw on Twitter, and if not, we'll be introducing him in just a second here. But first, Money Mander, good morning.
Good morning. My week could be better, and I'll tell you why. Castellanos better get out of my city so fast. 0 for 21 on his last 21 at-bats. Can't believe it. An unfortunate end of the season.
Castellanos actually went from Babe Ruth to a guy that looked like he's never stood in the batter's box in his life. Really, the entire meat of the Phillies batting order got cold at the wrong time. The 3-2 lead, brother, I'll be honest, I thought you guys were heading to the World Series.
Hats off to the Diamondbacks. I mean, well-played series. But, yeah, Castellanos looked like he hadn't seen a fastball since 65.
All right. Diamond Trades, good morning.
Good morning. I am just a true hater. I woke up and just chose to be a hater today. I absolutely love that the Phillies are not going to be in the World Series. I do feel bad for my friend Mander, but hopefully he can rebound. I mean, they've got the Eagles still that just don't look like they're going to slow down anytime soon. So I don't feel too bad for him, to be completely honest with you.
Yeah, me neither. I'll be honest as well. I'm pretty happy to see the Phillies go, especially after they put a beating on my Marlins. All right, Kevin Green, good morning, brother. How you doing?
Doing pretty good. About yourself?
Doing well. Excited to have you on the show. We're going to be talking some energy later on. Before we get there, we'll start with our Fed forecast. Money Manor and Diamond, take it away.
Yes, let's start with the economic calendar for today and the rest of the week. Today we've got new home sales going to come in at 10 o'clock tomorrow. We'll really kick off the high impact news. We'll have durable goods and GDP before the open, as well as the weekly home sales, the weekly jobless claims rather, and the pending home sales at 10 o'clock. And then Friday we'll get core PCE, the Fed's preferred measure of inflation, as well as Michigan consumer sentiment, something to watch out for on Friday. Earnings, we already had Microsoft and Google, which we will definitely get into in a little bit, but we still have Meta and IBM to report after the close today, UPS tomorrow before the open, Amazon and Ford and Chipotle all Thursday after the close. So we still have a decent amount of earnings to come in, as well as Exxon and CVX Friday. We talked on Monday about how there was some consolidation in the energy sector as well. So it'll be interesting to see what the executives have to say about that. So far this week in trading, the markets have been mixed into the middle of the week, which should bring some clarity as far as earnings go. Some of the market's biggest companies. The S&P 500 is up about a little bit over 0.5%. The Dow's up 1.3-ish, and the Dow is clinging to green by about 0.08%. The 10-year yield has poked above 5% several times in intraday trading this week, but it's pulled back about 1% on the week total. As bonds saw a relief bounce. Billionaire investor Bill Ackman Monday announced that his firm closed out their short bond trade, stating there's too much uncertainty in both the economic and the macroeconomic and geopolitical arenas to remain short treasuries down here. Yields fall as treasury and bond prices rise. The S&P 500 yesterday was able to close back above that 200-day simple moving average. We talked on Monday about how that's going to be a key barometer for a lot of traders and investors for just like the short-term and really intermediate term trend of the market. We were able to close above yesterday. We're trading a little bit below that 200-day moving average here in pre-market, which is sitting at 422.68. Let's go ahead and dive into Microsoft numbers. Microsoft reported earnings yesterday after the bell that were above Wall Street's expectations, sending the stock as much as 6.3% higher. In after-hours trading, it's currently up about 4.5%. EPS came in at $2.99 a share versus $2.65 expected. The company reported $56.5 billion in revenue, up 13%, and higher than the 11% that analysts were expecting. Growth in their Azure cloud business, which is arguably their most important division, slowed to 29% compared to the previous quarter last year, but so that was below the pace that Microsoft posted the same quarter last year, but was above the preceding quarter and analyst expectations. Some additional numbers: Microsoft's intelligent cloud revenue, $24.26 billion versus $23.61 billion estimated. Productivity revenue came in at $18.6 billion versus $18.3 billion estimated. Some other important notes that come out of the Microsoft earnings: Microsoft's investments in AI increased about 70% this quarter as they continue to look to their ChatGPT acquisition to help them usher in a new era of dominance as a leader in the artificial intelligence space. On one of our very first Beat the Bells, I wish that we had this clip. Maybe we can go back and get it later. But on one of our very first Beat the Bells, we talked about the Microsoft Activision antitrust suit and how that was sort of going to be like an overhang on the business. That deal just got done this quarter, which is crazy. Like a complete year later, that business just got done this quarter. And that acquisition is expected to add about 10% to Microsoft's overall business moving forward. So they had some positive comments about that. Mander, what do you got?
These were two perfect companies to have earnings back to back, because Google, on the other hand, with a polar opposite reaction to the quarter's earnings posted yesterday on what at the surface looked like a pretty routine and positive double beat. So revenues came in at 76.7 billion versus 76 flat expected. So beat on revenue. EPS comes in at $1.55 per share versus $1.45 expected. Beat on EPS. Total ad rev plus 8.7% year over year. And YouTube ad rev with another beat by about 27 million, I believe. So it looked like beats around the board, right? Revenues reported showed up 11% year over year revenue growth in the third quarter. Rebounding in advertising pushed expansion into double digits for the first time in over a year here. So what's the big but? The big but, as Diamond stated with Microsoft, was in the cloud services. Probably the biggest thing for all three companies here, in Amazon with AWS, Google, and Microsoft, is going to be their cloud services. And so shares dropped about 7% in extended trading last night after cloud revenues came in with a miss of about 20 million on this business segment. That's been probably the biggest key area of investment that kind of pushed Google up to where it was trading at, now showing a major lag behind AWS and Microsoft Azure, especially after we're starting to see a lot of business funnel in here through the generative AI. Companies are starting to turn to a public cloud to try and run these hefty workloads. And to put into perspective kind of just how massive the growth and expectations were, Diamond said that Microsoft Azure's growth slowed to 29% year over year. Google's cloud grew 22% year over year and still went down 7% in after hours, showing just how much of an expansion is coming into this space and really what investors were pricing the stock at, expecting way more growth than just that. And obviously Google still massively lagging the other two in the space here. So we were kind of discussing Monday what type of sentiment we were going to get in this earnings round, whether it was going to be beats being rewarded or misses being significantly punished. So far over the last 2 weeks, the average one-day move for EPS beats on stocks plus 0.59%. The average one-day move for stocks missing on EPS this round minus 5.67%. And so far the sentiment has been really getting punished on the significant misses on earnings here, and really the ones beating or trading relatively flat or slightly up the next day.
I think that sort of resembles the overall market sentiment that we're in, right? It seems like any reason that the market has to like sell off or pull back, it'll definitely take that, and it sort of takes good news as okay, let's take a breather, maybe like a slow grind higher type of price action. That's really like intraday, at least that's what we've seen so far over the last like several weeks throughout October here. So yeah, I'm definitely interested to see what Amazon's got in store for us on Thursday and how the market wants to respond to that. But after this week, I mean, this is really going to be the largest week in terms of earnings. We do still have Apple next week, obviously, and Nvidia at some point down the road in November. But more or less, the largest percentage of S&P 500 earnings, I believe, are going to be out of the way by this week. So we'll have to see how the market wants to react to that. That'll wrap it up for us here at Fed Forecast. Pass back to Alejandro.
All right, awesome. Thanks, guys. Let's quickly take a look at the S&P futures before we pass things over to Kevin. So we've been looking at this trend line, guys, for a couple weeks now. It remains extremely important. This trend line in purple going across the screen here connects the lows from October 2022 low as well as the March lows of this year. Now, this is the main bull market trend line that ES traders are going to want to continue to monitor. When we got the failed breakdown below that trend line earlier this month, we saw a nice rally on the reclaim. Of course, that was a move to flush out longs, trap shorts. The reclaim set off a really nice failed breakdown setup of that trend line. So now that we are trading below this trend line, it's pretty obvious and clear to say that bears are in full control. The other important thing to watch is this recent low that we made at 42.13. But more importantly, we flushed below the October low and put in yet another failed breakdown. This one is, of course, a little bit different than the horizontal failed breakdown we got. This is simply, the diagonal failed breakdown that we got. This is simply a horizontal failed breakdown. And so we broke down below a key level of support. That was the previous October low. We reclaimed. We did get a nice pop earlier in this week. We had 5 straight down days in the S&P. And then finally, we're able to put in a really nice green day. And bulls are now going to want to look for continuation. If we make a new low, if we come back down and take out this 42.13, that is going to look ugly. But for now, as long as we're trading above that previous October low, bulls are in short-term control. And it's not until we regain this massive bull market trend line that we can talk about a trend shift and talk about seasonality starting to kick in into the later months of November and December, where typically the S&P starts to perform its strongest into the end of the year. So that's what we got. Very simple stuff looking at the higher time frames. Now, let's pass things over to Kevin. Kevin, energy markets have been getting a lot of attention given the headlines coming out of the Middle East. Of course, what's going on over there is awful. Sending thoughts and prayers. But when it comes to the markets, what is it that you're seeing? What is it that investors and traders should be focused on? How are tensions in the Middle East impacting energy markets at this time?
Yeah, definitely. We are actually seeing a little bit of volatility when it comes to the energy markets over the last 2 weeks. We did have this event that occurred on October 7th, but we actually did see a little bit of interest when it came to retail traders around that same time here. We actually did see them increase their long positions. But one thing that I always really want to focus on here is going to be what dealers are doing, what the producers are doing in themselves. If they are actually increasing their short positions, which indicate that they are hedging physical stock, then that actually provides you a little bit more of a bullish foundation. But we actually did not really see that. In fact, we've actually seen a little bit of a reduction in their short positions. Now, we have also seen rig counts starting to increase over the last 2 weeks, if you look at the Baker Hughes rig count. And so we are potentially seeing a situation where supply is coming back online here. We had a interesting situation where utilization rates kind of went down, and now seasonally we do actually see that, but they actually came down a little bit lower than what we would expect. So that also indicated that we had 2 situations actually happening right now. We are starting to see the impacts of OPEC plus really reducing their oil output, and some of that heavier crude, or that sour crude, if you will, is starting to come a little bit offline, and that is actually going to impact some of the byproducts like diesel, heating oil, and jet fuel. And it's not surprising. We've actually seen this impact before. And we have actually a chart up here that actually does resemble and provides you a little bit of context on a 15-year basis of where we are at right now. This is actually just a comparison chart of crude oil to gas, which is in blue. That's just the spread. And then what is happening with the 10-year treasury here. And we actually have seen this 7 times over the last 15 years, this huge dynamic shift when it comes to the spread between the 10-year and crude oil and gas spreads here. Now, eventually, that will actually close here, and you need 2 things to either happen. You either need to have crude oil and gasoline start to rise to meet the 10-year, or you need the 10-year to come down. That will actually close, and that's where this is going to be very interesting. You can see potentially a little bit of demand destruction, not a lot, but a little bit when it comes to rising interest rates, which is exactly what Jerome Powell and the Fed really wants to have happen. We did see a little bit of a decrease when it comes to demand, but we did also see export demand going higher as well. And so that's kind of offsetting this decrease domestically, but that also has a little bit of a floor, provides a little bit of a floor when you're looking at the energy markets as a whole. And right now we're really trying to just figure that out. Now, if we have supply actually coming back online here, that would actually relieve some pressure when it comes to demand, and that could be a little bit more of a bearish setup. We also have this 1-year daily chart just to kind of keep in mind here. We are in an uptrend. That sloping channel, that expanding channel does indicate that we should expect additional volatility to occur, as that is usually what technicians are really looking at here. So areas that I'm really focusing on is right now is at $85.50. That's going to be your area. That was the primary area of support as we broke through $90. We just broke through that. Now the next area of support to really look at is $82.50. If we break through that level, then last but not least is going to be the point of control on that volume profile, which is sitting at $79.75 here. Just note that we will probably see a lot of support around that particular level because we have the U.S. government searching for contracts around that level as far as having producers being able to refill the SPR. And then we also have OPEC Plus that's really hoping that they can keep crude oil above $75 in order for them to continue to stay profitable or continue to have their their margins be fairly healthy here. So there's some fundamental factors that provide some support for the energy market, but we are also in a seasonal time where we actually see a little bit of a drawdown or in demand when it comes to crude oil here. So these two factors are really battling it out. And if we do see this escalation within the Middle East go across borders, where we're talking about potentially Lebanon getting involved, and or we have Iran directly getting involved outside of utilizing their proxies, which seems like that's kind of what they're doing right now. That could also provide a little bit of a catalyst for a move to the upside. The Strait of Hormuz is actually the biggest key factor when it comes to Iran. They control that, and that strait controls around 20 to 30% of all oil traffic or transportation. And so if they do have a little bit of a slowdown or they stop that strait, once again, that's going to put pressure on oil prices to the upside here. And that's actually the biggest risk. Right now, we hear the political commentary on all sides really trying to dampen down some of the rhetoric. But unfortunately, if we do have a bad actor that does try to take action, I think that would be the first lever that Iran tries to pull in order to put some pressure here on the West. And that is where we could see some pressure to the upside. So right now, seasonally bearish. From a technical standpoint, we're kind of neutral to bearish in a sense, but anything can happen when you look at a geopolitical event.
All right, Kevin, the next thing I want to ask you here, for traders who are looking to get involved and actually want to trade the energy markets, we talked a little bit about this before we jumped on. There's certainly headline risk at the moment. You've been seeing some funny price action in the energy markets. What would you recommend new traders who are unfamiliar with the products you were discussing? How should they get their toes wet and start to trade these markets? What's the best way to go about it?
Yeah, I mean, this is not a recommendation, but there's a lot of different proxies that you can utilize in order to get exposure. I think the most popular one for retail traders is looking at the XLE or getting into energy companies in themselves. Now, one thing that's a little bit of a risk when it comes to that, energy prices and energy companies can diverge when it comes to prices. So even though you do have the exposure, it doesn't mean it's going to be a one-for-one direct impact. But once again, it does give you a little bit of exposure as other retail traders try to get into the space. There's also ETFs like the USO that has exposure to oil futures. Now, they're not going to have a one-to-one correlation with the front contract because they really layer out their contracts over 2 to 3 years in order to be able to hedge risk. We did see a couple of years ago when oil went negative, that was actually one of the situations or the issues that they had, is that they were so concentrated in the front month. Everybody wanted to try to pile in, and unfortunately, people got stuck. There's also micro contracts when you're looking at crude oil. There's the mini contracts, and then there's the large contracts. So there's a fair amount of products out there that get you exposure. I think right now it's the biggest focus is limiting risk, especially around a geopolitical event. And if you want to be able to limit risk, going long a futures contract may not be the best option, because yes, you can put stops on those particular products, but unfortunately, sometimes those stops can get filled, and they can get filled at pretty wide spreads if we do see a dramatic shift or a news headline that comes out. So looking at options contracts probably would be one of the ways to gain exposure to be able to limit risk, but also you do have a little bit of time decay. So it kind of just depends on how you really want to structure your trade and the investment objectives of that particular individual and the risk they're willing to take.
Awesome, Kevin. Thank you. Really appreciate you joining us this morning. This was a lot of fun, a lot of good information. We'll definitely have to have you on the show more often, brother. This is great.
Appreciate you.
All right, guys, that's going to do it for this morning's episode of Beat the Bell. Thank you, everybody, for tuning in. Thank you to Kevin once again for coming on the show. Phenomenal stuff. A lot of good information. Hope you guys were all paying attention. If not, you can, of course, play it back. We are live every Monday, Wednesday, and Friday. For those of you that are new to the show, we'll also be trading live all day in the King Capital Discord. You guys can go to king-capital.com or scan the QR code that is popping up on the screen momentarily. Other than that, appreciate everybody who tuned in. We'll see you guys Friday morning at 8:30 a.m. Eastern Time. Have a good one, everybody.